Good morning. It's Wednesday, August 14th. Yesterday I just returned from Washington, D.C. and the ITC shrimp hearing. And at the end of the day there was huge news from the Department of Commerce. They tagged Ecuador with an average duty rate on shrimp imports of about 11.68% in countervailing duties. This was a total shock because in the preliminary rulings in early June, Ecuador had a de minimis or 0% duty. These duties may be retroactive to early June. We're not sure, but this news this afternoon caused a complete disruption in the shrimp market, with some Ecuador producers suspending sales and everybody trying to figure out what they're going to do. The other big news from the Commerce Department ruling was that Thailand got a 0% duty along with Indonesia, which had got one in the preliminary phase. What this means is that for the entire countervailing duty case, which originally covered about 70% of U.S. shrimp imports, that knocks it down now to about 40%. And some of the lawyers think this shoots a hole in the entire case. Earlier today, I reported on the first half of the session, and that's the video I want to show you now. Good morning. Following the morning session of the International Trade Commission hearing on the shrimp countervailing duty case, it was distinctly my impression that several of the commissioners were skeptical of the arguments being presented by the Gulf domestic shrimp industry. The other major area where there was a lot of skepticism was on the reason for the decline in consumption, U.S. consumption of shrimp. There was a fair amount of discussion of price elasticity and of the fact that consumers are buying less shrimp because prices are so high. Why is this important? Well, the argument of the Gulf domestic industry is that imports suppress prices, and therefore if there was less imports or if there was a duty placed on imports, they would have the opportunity to raise prices. But what came out in some of the commission questions was that this opportunity to raise prices is likely not there if in fact consumption is already declining because prices are too high. In other words, it's the fact that shrimp prices are so high, there's competing sources of protein that's leading to this decline in shrimp consumption, and therefore it's not going to be a change in the condition of the Gulf shrimp industry should these CV duties be imposed. And the last thing that was important to this is the de minimis. Commerce has not issued, as of this morning, it's now about 1:30 in the afternoon, but Commerce has not issued their final duty determinations for the various countries. In their preliminary ruling, two countries, Ecuador and Indonesia, got de minimis or 0, and Thailand was very close to getting that same de minimis version as well. If in their final determination several countries have a de minimis or no duty, some of the commissioners asked whether that wouldn't sort of negate the type of relief that the Gulf domestic industry is seeking. They essentially said that if 2 or 3 of your countries have no duty, aren't those countries going to make up and increase their imports to compensate for whatever is cut back by the countries that do have duty? So therefore there may not be a remedy here. The tone of the questioning really seemed to be that the issues that were affecting the Gulf industry were more business issues that had to do with price of shrimp, elasticity of shrimp, had to do with increased investment, competition on the docks for shrimp, all of which are not really subject to being defined as injury caused by imports. If a majority of the Commission ends up holding this view, it would have a major ramification for this case. In the afternoon, the respondents, which is the shrimp industry that depends on imported shrimp, got to make their case with witnesses from Publix, from Cisco, from Costco. Jeff Stern from Central Seaway was there, really talking about the business of shrimp. And what was most important in the afternoon hearing was the challenge to the very idea that the Gulf shrimp industry, in fact, is injured. Because what's happened between 2010 and 2012 is the Gulf shrimp industry has increased market share, increased employment, increased investment, and all of these things mitigate against the idea that they've been injured by imports. Market share of imports is also going down. The reason that they're filing this suit is because they claim their profit margins have eroded. But when you look at what they're claiming for their erosion, it's based on a 40% increase in sales and administrative and equipment expenses. Now, at the same time that they were claiming this big increase in equipment percentage, they got a big payment from BP in terms of settlement from the 2010 oil spill. So what's happened is they've gone out and they've spent this money that they got from BP on things that are covered under sales and general expenses, and it makes their bottom line look really bad. But if they factor in the BP money as income or account for it in some way, the whole problem goes away. So the takeaway here is that several of the ITC commissioners were quite skeptical as to whether in fact there is an injury situation here. The reason this is important is because with the Commerce Department's final ruling slapping 11.68% duty on Ecuador, about 6.5% to 7% on India, about 1.5% to 5% on Vietnam, 0 for Thailand, 0 for Indonesia, and about 11% for Malaysia, about 17% for China. If the ITC rules that there's no injury, all of those duties go away. So that's going to be a hard-fought battle over the next 6 weeks. And until then, I think the markets are going to have a hard time digesting this. In Boston, Massachusetts, this is John Sackton.